Thanks for clicking. Canadians and everyone else will be paying higher interest rates in the future on U.S. debt problems. This according to my interview with Joe Brown, CEO of Heresy Financial. Brown, as we'll see, is incredibly well versed in the U.S. financial system and was one of the very few to predict early on that we'd see inflation back in 2020, stressing that when the government prints money and no one is working, prices will go up. I had the good fortune to speak to Mr. Brown about why inflation has been surprising to the upside over the past few months, if we can expect the Fed to cut rates in light of those surprises, how growing U.S. debt will affect us here in Canada, and why governments and central banks are so afraid of prices going down, or deflation. All of the issues that Brown and I are going to discuss today are going to become more and more salient as 2024 rolls on, and we try to understand the future path of Canadian monetary policy. We'll obviously continue to have updates out on that policy on this channel. Click like and subscribe if you want to get those updates. But for now, let's get into this interview. All right, so I'm joined here today by Joe Brown, CEO of Heresy Financial. Mr. Brown, I want to thank you for being on the show today.
Yeah, well, thank you for having me on.
Definitely. So I do want to get right into it and ask you about the surprise inflation rates that we've been seeing last week out of the US, this week, just yesterday out of Canada, and today out of the UK. Are these just blips, or is this a sign of things to come?
Yeah, great question. So obviously, as with all things in economics, you're going to have a ton of different factors that are going to feed into any given output, like the general level of prices, as accurately or as inaccurately as that can be measured. So when we look at how the CPI is measured, it's basically trying to get an average level of prices of a bunch of different things that they say encompass what the average American will need to buy, the average American's cost of living. Everybody's going to have a different personal CPI than the official CPI, obviously, but they say they do the best they can. There are other measures of inflation that some of them say that inflation is much higher than that. Some of them say inflation is actually lower than the official reading. It just depends on how you measure it. And so one of the things that goes in as one of the largest inputs to the rate of inflation or to the general price level is the money supply. So if we just say everything else is equal, like nothing else changes, and every dollar suddenly becomes $2. So you evenly everywhere, you double the dollar supply. That would, all else being equal, double prices, because instead of your income being 50 grand a year, suddenly your income would be 100 grand a year. Instead of having 10 grand in your bank account, you'd have 20 grand in your bank account. Instead of rent being 2 grand a month, it'd be 4 grand a month. So the net result would actually be like the numbers would change, but there'd be no felt difference in anything. The only difference would be, hey, the number changed, but that's equal as far as income and expenses go. So money supply is a huge contributing factor to what prices do. The problem is that money supply doesn't actually increase or decrease in that way. You have to follow where the money hits first. So when we had all the money printing around the world that happened in 2020 and 2021, we have to look at the first place that went. And it went primarily to governments, and then those governments handed it out to businesses, organizations, politicians, and individuals through things like stimulus checks. And so that all went straight into the banking system. And obviously that allowed a huge increase in spending when there hadn't been yet a big increase in the production of the things that people were buying. And so just like an auction, you have increased demand, more buyers, it's going to drive up the price for everything and cause shortages. And that's obviously exactly what we saw. That did contribute to other downstream complications like supply chains, and especially with government lockdowns around the world. Obviously, there were a lot of factors going into this. But the money supply changing so rapidly was one of, if not the biggest contributing factor. So fast forward to today, why is it that we haven't seen the inflation rate fall down to 2%, 1%, 0%, or even go negative yet, considering the fact that the money printing hasn't been happening for a while? Well, when we look at the money supply in the US, it's measured by M2. That's the most accurate, in my opinion, measure of the money supply, because it looks at anything that can be readily used as cash, like bank accounts, savings accounts, just cash in any general sense. Um, it was declining for a while, pretty much in lockstep with the rate of inflation dropping. And since May of 2023, the money supply has actually stayed even. We can get into the mechanics of why that is, but basically, a lot of the money that was printed in 2020 and 2021 got sucked out of the banking system through the Federal Reserve's reverse repo facility. And over the last 8 months, that's been coming back into the money supply. So yes, the Federal Reserve has been on one hand trying to take money out of circulation. Um, there's been the same amount of money basically flowing back into circulation. So net, the money supply hasn't actually changed since May. And so that's why the CPI has flatlined and it has stopped dropping. And there's going to be, little ups and downs from other supply chain issues and from things like, shipping now has to go around the Horn of Africa and things like that. There's going to be all sorts of factors that will contribute on top of just the money supply. But bottom line is we haven't seen the money supply shrink since May of 2023. And until that starts happening again, the inflation rate won't be going down.
That makes sense. So now I've heard you talk about this before and about money trickling out of the reverse repo facility. And by your accounts, over the next few months, it should be drained.
Yeah, so
So,
you can look at how fast the money is coming out of there, and this is completely like free market. This isn't an account that the Federal Reserve fills up or takes down or pushes out or takes in. Like they don't directly control this. They just pay an interest rate in that account. And so money market funds, which is where people have a lot of cash right now, they're looking at where to put the cash. So if you have a money market fund, you're getting paid, 5% on your money market fund. The money market fund itself is saying, where do we get the highest return for, like if we put our money somewhere for a very short term amount of time, like overnight or a week or a couple of weeks, where can we get the highest return? For a while, that was the reverse repo facility. So money markets had it in the reverse repo facility. But now, T-bills, which are the shortest term US government debt, have been paying a higher rate than the reverse repo facility has. So money markets are taking more and more and more money out of the reverse repo facility and putting it into T-bills. That's the mechanism by which it's been leaving and going back into the banking system, because when the government borrows money, then they spend it, and that goes into somebody's bank account, whether it's a bank account of a corporation, a organization, politician's paycheck, whatever. Like it goes back into the banking system. So you can look since May, just based on government borrowing, how fast the money has been leaving the reverse repo facility. And March would be kind of like the uh, average, kind of like the target estimate on when that account will be fully empty and fully drained. And once that happens, there's no more like slush fund of cash outside of the banking system that can be pulled back in. So on net, the money supply will start to decrease again at that point.
and at that point, will that allow the Fed to lower rates if they need to once inflation starts dropping down because the money supply is being sucked out of the system?
Yeah, obviously there's a little bit of a lag effect. And so let's say if by March that facility is empty, then the inflation readings that come out over, May and June will start to show the CPI starts to drop, assuming nothing else counteracts it. But even if, let's say, like if the government ends up borrowing more and more and more and more, that in and of itself does not drive the money supply higher, because at that point they're just borrowing from Sally and paying it to John. Like it's just a money transfer system. The government is. So the only time that increases the money supply is when it's that money is being loaned into existence. And so all we have to do is watch the M2, the money supply, and what you'll see is when the reverse repo facility hits zero, money supply will start to drop again. And then yeah, if the inflation rate over the next couple of months after that drops to 2 or 1%, I would not be surprised at all to see the Federal Reserve lower interest rates, because they're trying to maintain a positive real interest rate of like 2%. And with inflation at, let's say, 3% and the interest rate at 5, well, that's a real positive interest rate of 2%, just the difference. So if the inflation rate drops to 1%, well, they need to drop interest rates to 3% to maintain positive 2% rates.
To keep it around neutral.
Um, I mean, it depends on your definition of neutral. But if they keep rates at 5%, and the inflation rate drops to 1%, then the real inflation rate is going from, I'm sorry, the real positive interest rate goes from 2% to 4%, because your dollars are only losing 1% per year now in value. But if the interest rate stays 5, then you're gaining a bigger positive real return. And the Fed's thinking is that that's dangerous, because with interest rates that high on a real basis, that can slow down economic activity because it destroys lending. And so they want to keep real interest rates, they've stated, somewhere around the 2% mark. So yeah, if interest rates fall to 1%, then they'll lower interest rates, not all the way to 1%, but they'll lower interest rates to maintain about 2% real rates.
To maintain that balance. So we're not overheating, but we're not cooling it.
Yeah, because the last thing they want to do right now is reignite inflation. If they drop rates to like 1%, like, you have a huge boom in borrowing again. You have a huge boom in government spending. That's money being lent into existence. Money supply starts to shoot up again. Then you could have, a very quick reignition of inflation and a repeat of the 70s. And I think that's kind of inevitable anyway. But they're trying to avoid that. I don't think they will avoid it, but they are trying to.
And actually, that's a good point that I did want to ask you about, because our own central bank governor has warned repeatedly that they're very conscious about the lessons from the 70s, in that
Yeah.
if you lower rates too soon after a bout with inflation, it's going to take right back off again. So if the Fed does lower rates, do you think that if they lower rates by, say, the 3 to 6 that the markets are predicting, do you think inflation takes back off if they lower, say, in the next 3 to 6 months?
Yeah, so we're kind of we're on a tightrope right now with like inflation on one side, deflation on the other side. So let's say they lower rates by 0.5% or 1% over the next year. Some would say that's a very mild rate cutting for a year. I think that probably would not be enough to hold off a recession. We have a lot of indicators showing economic activity is slowing down extremely rapidly, and just a very mild rate cut like that would not be enough to offset that slowdown in economic activity. And so I think we dip into a recession as a result. Now, the funny thing about recession is prices usually drop, especially asset prices. And so we could very easily tip over into deflation, which is, again, one thing that central banks absolutely are terrified of. In the long run, I think that's actually a healthier option to allow a recession, to allow economic slowdown, to allow some deflation. You burn out some of the deadwood in the economy, allow bankruptcies to happen, allow some sort of a financial reset, not in the way that other people talk about it, but just like a free market reset where all of the stuff that is destructive to wealth kind of dies, and assets are transferred into the more conservative and competent hands. I think that's healthy long term. So I don't think they're going to let that happen, though. I think they're too scared of deflation. They'll start to lower rates faster and faster and faster to stop the deflation, to stop the recession. And then at some point they'll go a little bit too far, and then they will re-trigger inflation again.
And then we're back off to the races.
Yeah.
Okay.
Yeah.
Gotcha. No, actually, you raise a good point. Can you explain to my viewers, why are central bankers so worried about deflation?
That's a good question. It's actually historically pretty new that central bankers have been publicly afraid of deflation. I think it started in the late 80s, early 90s, when you started seeing central bankers talk about how bad it would be if we got deflation. And so we must target an inflation rate that's a little bit higher than zero, to make sure we don't tip over into deflation. Really, before that, you didn't have that kind of rhetoric. Maybe it was happening behind the scenes, but it wasn't public. And so it was kind of slowly dripped on the public, to the point where after 10, 20 years of that, it's just mainstream economics now that deflation is bad. And certainly from the point of the debtor, deflation is bad. The borrower, deflation is bad. Because ultimately, deflation, inflation, you're looking at either the dollar is increasing in value or decreasing in value. If the dollar is increasing in value, that means you can buy more stuff with dollars. That means it takes more stuff to get dollars. Takes more hours of labor to get dollars. And in fact, for most of human history, except for little isolated bouts of inflation, you do get natural progression of deflation because the pace at which the amount of wealth grows outpaces the growth of the money supply, especially during boom times of like the agricultural revolution and the industrial revolution and the tech revolution and the internet. And when you have these booms in productivity and total output and wealth, that many times can be faster than the increase in the money supply. And so the amount of labor then, if we measure it in human labor on average, average man hours that it takes in order to pay for, a standard cost of living. When you look at how much do you have to work to be able to afford food, shelter, clothing, transportation, the basic stuff, over history, that has plummeted significantly. Um, and so that's natural deflation that has taken place. But then you have these short little time periods. By short, sometimes it can be decades, but in the course of history, that's short, where that progress or that path reverses. It actually takes more money to get the same amount of stuff, or even less stuff. And so when you look at how that affects debt, well, when you have to pay debt back, would you rather have to pay it back with something that is harder to get or with something that's easier to get? So let me phrase it a different way. You buy a house with debt worth $300,000. Later, just because of money printing and inflation, nothing else, let's say, in our hypothetical example, that house is now worth $600,000. Well, you can sell that house, pay off the debt, you have $300,000 left over. That's the value of the dollars going down. Put another way, how hard is it to continue to service the cost of that debt? So your mortgage payment, let's say, is $2,000, and maybe that takes you a full-time job to pay for that mortgage. But as the money is printed over the course of the next decades, 20 years later, it takes you a low-skilled part-time job to pay the exact same mortgage. And that's exactly what's happened over the last 30 years. You look at houses and mortgages, look at the average house payment back in the 1980s, look at the average house price. And if you were to, if you had that mortgage, you started 30 years ago, today it'd be very, 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 very easy to make that payment. And that's a result of the dollars losing value. It takes less and less stuff to get the same amount of dollars. And so from the standpoint of the borrower, you want inflation. You want the dollars to decrease in value. It makes it easier to get those dollars to pay off that debt. So who's the biggest borrower? Well, it's going to be the U.S. government or central governments around the world. It's going to be the large corporations that have the biggest budgets to lobby and wield their influence on the government's political decisions. So when you look at the decision makers, who's pulling the strings, number one, they're the biggest borrowers. Number two, they're the ones making the decisions. And so if the people who are making the decisions are the biggest borrowers, then the decisions they're going to make is probably going to benefit the fact that they're the biggest borrowers, which means inflation. Now, it is true that the alternative could be a quick, devastating death spiral of debt, which is usually beneficial to the lenders when you have deflation. In some instances, you can have deflation that's so rapid where the defaults end up, the lenders get burned anyway because of the defaults. But in general, deflation is good for the lenders because they get paid back with dollars that are worth more than what they lent. And there are, net, the decision makers are far more on the borrowing side than the lending side.
Wow, that's a great explanation. Thanks. That's great that you went into that. And I think it feeds into what I wanted to talk about next, which is US debt, which I know you've talked about at great length, and we've talked about it a lot on my channel, and how that's going to affect the rest of us. And today, actually, we saw the 20-year bond auction. It tailed. There was weak demand for it. Can you kind of go into what that means for the US and what that means going into 2024?
Yeah, absolutely. So, have you gone into what that means when auctions tail, or would you like me to do that?
If you could do it briefly, yeah, just
Yeah.
for readers
Okay.
that haven't watched.
Sure. Yeah. So basically, when the government says, hey, we want to borrow money, they're going to do this through an auction. They're going to create these bonds that they call US Treasuries, or every, central government has, their own names for them, but it's sovereign debt. So they're going to say, hey, we're going to create one of these bonds and we're going to sell it. This bond means we'll pay you back, $1,000 plus interest in 20 years. And so we're going to sell it off and see if you'll pay, $1,000 for it. And if you will only pay $999 for it, then the interest rate is going to be higher because I'm saying I'm going to pay you back a certain amount of interest. So prices and interest rates on bonds, they're inversely correlated. If you only pay me $1 and I have to pay you $110 or $1,010 back, the interest rate on that is massive, right? If you pay me $2,000 and I only have to pay you $1,010 back, well, that's a negative interest rate. So the government says, hey, we're going to auction off some debt. And if you're an individual and you want to participate in that, you just have to do it at the rate at which the government says that they're borrowing. So if they say, hey, we're borrowing at 4%, as an individual, that's my only option. I either choose, yes, I want to do 4%, or no, I don't want to participate at all. Institutions can choose. They can say, we want to participate, but only if we can get a 5% interest rate or, something else. So then the way that the government does this is they say, okay, we're going to meet all of the bids that just accepted what we were offering for the interest rate. And then we're going to move to everybody else who has tried to demand a higher interest rate. If we only want to borrow $1 billion and there's enough demand at what interest rate we want, then obviously we stop there, $1 billion at 4%. But if we want to borrow $1 billion and there's only 500 million on the table at the interest rate we want, now we have to go to the people who want the higher interest rate and see if we can fill up the rest of our auction. And usually, I mean, they do fill up the rest of their auction. Usually, there's plenty of bids out there. It's just at higher and higher interest rates. The thing about an auction, though, is whoever is the highest interest rate bidder, that interest rate gets applied to everybody who participated in the auction. And so if the government says, hey, we want to borrow at 4%, and they have to go to higher bidders and they get to the one who says 5%, everybody gets 5%. And so the difference between what the government wanted to pay on its interest rate versus what they ended up having to pay at that auction for the interest rate is called the tail. And the longer the tail, the worse the auction. And you rarely have big differences. And recently there have been a few times where there has been percentage-wise a very big difference. And that's going to happen more and more. The more that happens, the more it shows there's just not enough money out there to lend to the government. So if they want to borrow money, they have to pay a higher and higher interest rate. That's going to happen more and more, especially as the reverse repo facility drains. And the amount of reserves, the amount of cash in the system decreases, which means that government borrowing costs are going to go up unless a central bank like the Fed intervenes.
And when borrowing cost goes up for the US, it goes up for everybody else as well.
Yes, exactly. That's a great point, because if I'm sitting here and I'm choosing who I'm going to lend my hard-earned cash to, I can lend it to the US government, let's say at 5%, and when push comes to shove, they can use the military, they can use the IRS, they can use more borrowing, they can use the printer, they can do anything they want to pay me that money back. And they will, because if they default, they never get to borrow again. I can look at somebody else and I can say, okay, I can loan to a corporation, but the only way I get paid back is if they have enough profits to pay me back. They don't have a military. They can't put somebody in jail for not, paying the Amazon Prime subscription. They don't have the monopoly on violence to make sure they can pay me back no matter what. So that has a higher chance of failing. Maybe it's only a little bit higher chance, but there's still a little bit of higher chance that fails. So if I'm looking and they're both 5%, I'm going to go with the safer option. The only way I choose the less safe option is if the return is substantially enough higher that it compensates me for that extra risk. And so the higher government borrowing costs go, the higher capital costs get for everybody.
So absent the Fed stepping in and buying up the government debt, basically monetizing the debt, you think that interest rates are going to continue to go up over the coming months and years ahead with demand for US debt, or rather so much US debt coming to the market, there's not enough money out there at current rates to handle it. Is that correct? Absent the Fed stepping in.
Yeah, and actually, even with the Fed stepping in, so that might seem counterintuitive. So, and it's something that is, I have to, disclaimer, this is not a widely held opinion. This is, I believe I'm in the minority on this opinion here, that when the Fed steps in and starts up QE again, it's not going to result in lower interest rates for anybody but the government. So yeah, the government's going to have to pay more and more and more for the interest rate on its debt. Um, it's paying like $1 to $1.2 trillion right now per year just in the interest portion on the national debt. So the U.S. government only spends like, I say only, but it's like 6 trillion a year. So over a sixth of that is just on the interest on the debt. And the higher interest rate it has to pay, like this year alone in 2024, the US government has over $8 trillion of its debt maturing, which means it's running a deficit, which means it's not paying that off of taxes. It's paying that off by borrowing new debt. So it's like a credit card balance transfer. They're going to have to borrow $8 trillion more this year just to pay off the old debt. So their national debt should go down by 8 trillion because 8 trillion is due to be paid back, but they're going to borrow 8 trillion to pay it back. So that won't have a net change effect on the national debt. But it will have an effect on the interest cost because most of that debt was borrowed at 0.5%, 1%, 1.5%, 2%, 3%. And now they're borrowing at 4%, 4.5%, 5%. So that's a significant increase in the cost of that debt that's being rolled over. In some cases, it's doubling or tripling the debt service cost. So that interest portion on the debt is going to continue to grow into the future. We will get to a point in the future where they won't be able to borrow enough to pay those high interest rates because there's not enough cash in the system. At that point, government auctions fail because they try and borrow. There's not enough. They're trying to borrow $1 billion and only 500 million comes to the table. So they can't borrow what they need. At that point, if they haven't already, the Fed will step in. They'll print the money necessary to inject into the banking system so the banking system can loan that to the government. So that's a restart of QE, quantitative easing, where the Federal Reserve is buying US government debt. It's taking that off the market, putting cash in its place so that cash can go be lent to the government. It's recycling. It's indirect, but it's the same thing as the Fed printing money to loan straight to the government. It's just the banks are in the middle. So that will happen again. The problem is when that happens, suddenly government spending changes from being a transfer of dollars, right? They're borrowing from a bank or from Aunt Sally to pay to a social security check, healthcare company, military industrial complex, politician's paycheck. Those are dollar transfers right now. When the Fed steps in and starts printing money for that again, that becomes an increase in the money supply. For every dollar the government spends that the Fed buys that debt, that's an increase in the money supply. So government spending becomes inflationary again at that point once QE restarts. When inflation enters the game again, all of the free market lenders understand we have to be compensated beyond the rate of inflation. So if I lend you money at 5% right now, I'm only doing that because I believe the rate of inflation over that same time period will be less than 5%. But if QE restarts, federal spending goes through the roof, and now as a lender, I realize inflation might be 7 or 8 or 9% over that same time period. Well, I'm only going to lend to you at 10 or 11 or 12%. And so while the federal government will get lower borrowing rates in order to sustain their unsustainable spending, that won't translate into lower rates for anybody else. It'll in fact transfer over to higher rates for everybody else.
So are you talking about the bond vigilantes when you're saying how the market won't stand for it, that they're gonna push rates up due to inflation?
No. So like in 20 the end of 2018 and then through 2019, we had a situation where the US government was running massive deficits. I mean, this is something like politically, I have no friends politically because there's about half the population that hates what's going on right now, but they also ignore what happened for 4 years under the predecessor, deficits exploded at an unbelievable pace. And there was an insane amount of borrowing going on when there wasn't a recession. Um, and so when we look at what was happening in 2019, the federal government was borrowing so much money that they sucked all the cash out of the system. So I don't know if you remember, in September of 2019, the repo market blew up. Uh, all of the banks, they come together every night to borrow or lend cash to each other, depending on which banks need what. And in September of 2019, they tried to do that. Everybody needed cash. Nobody had the cash. Everybody had collateral. And so there was a little bit of cash. So the rate for that cash just skyrocketed. The Fed had to step in and start up not QE, interject money into the repo market to prevent banks from collapsing overnight. There just wasn't enough cash because the government borrowed it all. Eventually, we get to that same exact point. They're just borrowing so much that eventually they get to a failed auction. They try and borrow. There's not enough money on the table for them to borrow from.
Right, right. But what I mean is that you said that the U.S. government will be the beneficiary of the QE, but investors, market participants, are going to want to lend for they know inflation's coming, so they're going to lend for higher rates, right? So because they're going to want to be
Yeah,
compensated for that
right.
monetization of the debt. So when the Fed restarts QE, do you think yields go up, or is the bond market going to be are they going to be okay with the Fed restarting QE, or is the writing on the wall at that point?
Yeah, government borrowing rates will go down because you have a buyer who has unlimited capacity to print money to buy those bonds.
Right.
So as it increases the price of those government bonds, the interest rate on those government bonds goes down. There will be a huge disconnect, though, between the treasury market and the rest of the bond market.
Right. That's right.
All other forms of debt will get much cheaper. The interest rate will go much higher because you won't have the Fed buying up that debt. They're only going to be buying government debt. I don't know. At some point, they may buy other debt too. That would require a reworking of the Federal Reserve Act because they're not allowed to buy other debt right now. So they might try to, in some form, if there's some catastrophic events in public debt markets. But that's a lot less likely, in my opinion.
So at that point, is it just U.S. government debt that gets cheaper, or what's that mean for the rest of us? Like, what's that mean for Canada,
Yeah,
for everybody else?
it means like for individuals and institutions, you're going to have to pay a lot more to borrow money.
Right.
So there's this going the kind of the assumption right now is we've had an abnormal period of time for the last year or 2 years where borrowing rates have been abnormally high, and in the future, soon, interest rates will get back down to normal. That is false in the standpoint of a longer historical context. In a longer historical context, rates are not even back up to normal average levels right now. We are not abnormally high right now. We were abnormally low for a long period of time. And so we are in a period of time, at least a decade, where the average interest rate for the average individual institution is going to be as high or higher than it is right now. Inflation is sticking around for a lot longer, which is going to be a driver of that. Inflation is sticking around because governments are going to have to start monetizing their debt, which is going to be a driver of that. And so, yeah, inflation and interest rates for everybody else are going to be much higher than what people expect for a much longer period of time than people expect. And the only person who's going to be benefiting is the governments, who are just going to be printing what they need to spend.
Right. And I wanted to ask you, how long can the US do this? I know I've heard you talk about this before about the US debt exploding right now. It's at 34 trillion. With entitlements, it's set to rise. I think it's by over 40 trillion by 2027. So if I remember correctly, um, what's the limit on US debt? And I ask this because our own former Bank of Canada Governor David Dodge made headlines last week warning about the limits that warning about a potential US debt crisis. How long can this go on? How long can the US monetize its debt, rely on the Fed before everyone else stops taking those dollars?
That is a really good question, and I don't have an answer for you on that because the U.S. government is in the unique situation of controlling the global reserve currency. And so you can always say, well, that won't last forever. And that is 100% true. And the more you abuse the currency, the faster its demise will come, even if everybody around the world does use it right now. The one thing that is keeping its strength and will keep it around much longer than you'll hear a lot of people talking about, BRICS and gold-backed currencies and Asia and Russia and commodity-backed currencies. And the problem is there's over $100 trillion of dollar-denominated debt around the world, not including the US. So when I borrow dollars, I have to pay back dollars, which means I have to get dollars to pay off that debt. And the only way to get dollars is to sell something to somebody who has dollars. And so the fact that dollar denominated debt is so entrenched around the world is a built-in massive amount of demand for the foreseeable future for dollars. Now you could say everybody could default at once, and sure, but good luck trying to coordinate on that, because if somebody doesn't, they're the winner. So the only way that type of thing works is if literally everybody participates. And so game theory kind of prevents that that situation from happening. And so every individual and institution and nation around the world who has a bunch of dollar denominated debt is in a situation where they're trying to do things like you see all of these headlines about, I believe it was it wasn't Argentina or Brazil. It was a South American country recently negotiated settlement with China in yuan, and everybody was saying, hey, this is de-dollarization. But when you dig deeper at the reason why, it's because the nation had a dollar shortage, so they were trying to save up dollars that they had to spend. So they're like, okay, we'll pay China in yuan so that we don't have to send them dollars, so we can use those dollars for other things that we need dollars for. So it actually was, it wasn't motivated out of de-dollarization. It was motivated out of the literal exact opposite. Now, I'm not making a case that the dollar is set in stone for forever. Obviously, the more you abuse your currency, the faster it falls. And the more debt we have and the more we monetize that debt through the money printer, the faster those nations around the world will be able to get rid of that debt easier and easier. But it's most likely going to take a lot longer than many people think. Many people who think the dollar is going to die tomorrow, they're going to be wrong for a lot longer than they think they are. I mean, look at, in the course of history, we read about the fall of empires in the course of a couple of pages. Usually that takes place over decades or sometimes even centuries. So it's not going to happen overnight. But yeah, the more the government borrows and the more they finance that borrowing through the printer, the faster it accelerates the inevitable collapse, and at some point the dollar won't be used at all.
But it's a long way off. It's not imminent.
Decades.
Decades. Yeah.
Yeah.
Yeah. 100 trillion in debt. There's going to be demand for dollars for quite some time, regardless of what the Fed does.
Correct. Yeah. So I wouldn't be surprised. Like you said, by the year 2027 or 2028, the US national debt will be at 40 trillion. By the year 2050, 2060, it'll be at 100 trillion. And nobody ever expected it to get to 1 trillion in the first place. Now, there's always going to be more problems cropping up along the way as a result of all of this. But I believe like the actual collapse where, we don't see the dollar being used in circulation anymore, like the Continental is not in circulation anymore. That's going to take a lot longer to happen than many people think.
Well, that's thank you for explaining that, because I think there's a lot of people out there that think where the sky is going to fall imminently, the U.S. that the world is going to drop the dollar, and it's a bit more complicated than that, I think. And I think you explained that quite well. So I appreciate that.
Mm.
Um, I also wanted to ask you, you talk about on your channel that we're in a new stage of inflation, that we had 40 years of low inflation, and now we're heading into a new era. Can you explain that a little bit more?
Yeah. So first, I want to say I'm talking about the rate of inflation. I'm
Yeah.
not talking about the absolute level of prices, and that does need a distinction because everybody kind of gets upset when they hear, "Hey, the rate of inflation has fallen." Um, they don't mean prices have fallen. They mean prices are rising slower. So when you look at a chart of the rate of inflation and you look at a chart of interest rates, what you'll see is that from about 1940 through 1980, those things were rising. Inflation and interest rates were rising as a result of a bunch of different factors. Money supply, money printing, government's growing, all sorts of things, World War II ending. So from 1940 through 1980, interest rates and inflation were both moving higher. That peaked in 1980. So that was a 40-year time period. From 1980 through 2020, the next 40 years, both of those things were falling. The rate of inflation and interest rates were both falling. Now, there are time periods where it's volatile. It's not a straight line. So when over that 40-year period it was falling, yeah, there were some times when it went up. On average, for 40 years, it went down. So we have this longer term debt cycle that takes around 40 years. The last 40 years, it was falling. The 40 years prior to that, it was rising. And the years prior to that, it was falling. And so when we look at 2020, that ended that 40-year cycle. We had interest rates hit zero. You can't go much lower than that. There have been certain places and certain times that go a little bit negative for a short amount of time. It's not sustainable. Here in the US, we hit zero. That was the bottom. Since then, interest rates and inflation have been moving higher. So again, many people are thinking, hey, this is abnormal. We need to have interest rates go lower. But historically, lower interest rates than where we're at right now have been what's been abnormal. We have entered into a new period of time here, the next phase of this long-term debt cycle that's going to be very similar to the 40s and the 80s, from 1940 through 1980, where inflation and interest rates are moving higher. The massive buildup of U.S. government debt right now, when you look at debt compared to GDP, we're about 120%. Guess where we were following World War II? Right around 120%. So we had this massive, and that was 1945 or something, when we hit 120. So we have very similar setups here where we have massive public debt that has gotten us into a situation where the only way to deleverage is through printing that away. And that will cause inflation, and that will cause rising rates for everybody else, just like it did from 1940 through 1980. And so it may not be exactly 40 years. Nothing's ever exact, although the last two cycles were pretty close. It may be shorter than that. It may be longer than that. But it's probably going to be longer than 3 years. And I would put my money on it being at least longer than another decade here of rising inflation and rising rates.
It's interesting because we're hearing more and more from central bankers, from our own central bankers, warning about higher inflation coming, that the last 15 years weren't normal, and prices and interest rates are going to be higher in the decades to come. But they usually reference retirees, climate change, etc. They don't often reference government debt for the reasons for that, or the increase in the money supply as a reason for that. So it's interesting to see both perspectives. Do you think they're do you think that do you think that the government understands that what they've done, that they know that the debt and the money supply is going to be causing that inflation, and are just priming the population for that relative increase in the cost of borrowing and prices?
That's certainly possible. I don't know how much interaction you've had with politicians and people who work for the government, bureaucrats, lifelong government employees. Um, I almost always attribute consequences to incompetence rather than malevolence.
Right.
The hardest working, most competent people seek the biggest rewards, and they don't go into politics. They don't become government bureaucrats. They're trying to actually produce things in the real world. And even there, you have, in the free markets, you have massive amounts of failure. You have people and institutions that fail all the time when they're with good intentions, trying to do the best thing possible, and they're very highly skilled. You still have a lot of loss. You still have a lot of failure. Now I think about taking an institution that's even larger, like a central government, and trying to coordinate those people and those bifurcated organizations. Again, a bunch of self-centered people all trying to get ahead for themselves, but are a lot less competent, which is why they're in those positions in the first place, and trying to corral them for a secret agenda that is going to be hurtful to the population. If they were able to pull that off, and it was, all of this being done out of malevolence, they'd be the most competent people in the world. I mean, they could accomplish literally anything. And when you look at the track record, there's not a lot of evidence of that. And so I always attribute, negative consequences as a result of government actions. I attribute that to incompetence, almost always. And at the end of the day, it actually doesn't really, matter, because the result is the same. But when we look at things like, hey, they're saying we're going to have, higher inflation and things like that, there is some truth to some of the things that they're pointing at causing those things, like retirees. When you look at imploding populations, that's very, very, very bad for nations and economies. Like, you don't want a growing population that cannot work and a shrinking population doing all the work. That's a recipe for disaster. And so that's certainly a contributing factor. When you look at things like deglobalization, absolutely could be a big contributing factor to this. When you look at servicing the cost of the government and how much of a tumor that is, taking resources away from a growing body, a growing economy, and not being able to perform the functions of making sure that global shipping routes are safe. Like, that was what the military has been doing for decades, that has caused such a boom in global commerce. Well, guess what? They're not doing that great of a job at that anymore. Pretty soon, within the next 10, maybe 20 years, it won't be uncommon for Amazon. They're going to have to hire their own private security companies, their own gunships that protect their own travel routes, their own shipping routes, so that they don't get, taken by pirates and stuff. So absolutely, that's going to become a thing. So we're not only going to be paying for an incompetent government that can't give us the services that we're actually paying for, but we're going to have to pay a higher cost for everything else, as a result of doing that job ourselves. And so, yeah, there's certainly a bunch of factors going to be going on that are going to contribute to higher prices that are not just due to, the money supply, for, let's say.
Could be a new source of revenue for the U.S. Hiring or contracting their services out to Amazon.
Yeah, I mean,
that was a joke. Obviously not.
Oh, okay.
Not very well executed.
Yeah,
the military, they're really good at it.
Yes, you definitely, like, this is one of those things where, like, incompetence comes in. It's like, when you look at the military spending, for about 15 years, they were buying coffee cups that had handles that would break after about 30 days. And so the US Air Force spent, I don't know, something like $300 million just on replacements over 10 years for coffee cups. And the coffee cup company knew that the handles were broken, and they would ship these cups anyway, because they knew it would result in more orders. And it's so bifurcated and spread out and bureaucratic and disorganized that nobody realized this was happening until 10 years later, and all the money was wasted. It's like, private markets would be much more efficient at 90% of what the US military does. Obviously, take away war, take away, the initiation of violence, the stuff that they're, trying to protect global shipping routes for commerce and stuff like that. So yeah, if you can take some of those, people away and hire them in the free market and do it more efficiently, where there's actually rule of law and there's actually, skin in the game, for I'm not allowed to just go out and kill somebody because I'm a civilian and that's murder, absolutely, all that would, probably have much better results.
Right. Less inflationary too.
Sure. Yeah.
Yes. Okay. I know your time is limited, so before we go, I do want to ask you, what's the number one thing that us as Canadians should be looking for when we're looking at interest rates, when we're looking at how 2024 and even 2025 is going to go? What should we be looking at coming out of the US?
The number one, well, a couple of things. I'd watch the money supply, as kind of one of the main, thermometers on the economy, because that's a leading indicator. Watching the money supply, you'll start to see, hey, we've got deflation ahead, or hey, money supply is increasing again, we've got inflation ahead. So definitely watch that. I would start to watch the difference between interest rates on like regular debt versus government debt. If and when that starts to really separate, that's a big factor that will influence things for a long term. Um, and specifically, I mean, we didn't get into real estate at all. Um, the US real estate market is, I would say very, very dissimilar to the rest of the world because 30-year fixed rate mortgages are, not a thing most places. Um, and so I'd be very wary of getting into any debt um, that has the ability to change on you in the future. Because if inflation takes off again, you could lose everything that you have because you can't afford the debt and everything gets, all the collateral gets repossessed. So I'd be very, very wary of variable interest rate debt. Um, so I think, that's kind of like a personal thing to watch and continue to invest in assets that are outside of the financial system and protected against inflation, and making sure that if you need a way to escape, you have it before you actually need it.
So, well, I want to thank you so much for being on the channel today. This was an incredible amount of really, really great information. I will be linking to your channel in the comments, so hopefully the viewers can go over and check out all the great education that you have. I try not to miss an episode, so thank you so much for being on the show today.
Yeah, well, thank you again for having me on. It was a good time.
Very well.